Cool. Good morning, everybody. It's now 11 o'clock and we should probably get going because obviously being first of the session of the month is the lot to cover. So as usual, I've got a bit of news to do and then we'll be talking to Andrew Hattie. And then the plan is to talk to Peter Hewitt from CT Managed Portfolio. So without further ado, there's a few bits of news this week. I just pulled out two. So Pershing Square and the JPMorgan Japanese merger. Andrew's going to cover another one, which is the Crystal Amber thing. I was mentioned something else at the end. But Pershing Square first. This is massive. It's the second biggest fund in the sector. Maybe not as well known as it should be, given that, but there we go. It had a bit of a tumble last week, and we'll talk about that in a second. Morningstar, very good with the numbers on it. So we've got no NAV or discount chart on here, but the discount is about 25%. And it does have a small yield. The big story this week is that its planned US closed-end fund is not going to go ahead. So it was planning to IPO. When Bill Ackman was talking about it early on, he started banding around numbers like $25 billion, biggest IPO of all time or something. I don't know what closed-end fund IPO. Anyway, when it came down to it, they cut the target size, and they couldn't get to the 2 billion target that they wanted. And so they had to pull it, which is a bit of a come down, obviously. Now, the reason why this isn't interesting for shareholders, the Pershing Square holdings in London, is that the fees on the new US vehicle were supposed to offset the performance fees on the London one. So had it all gone ahead, we would have been much better off. The other thing that was supposed to happen, I think, was that he was going to buy a big chunk of Pershing Square Holdings' stake in Universal Music Group. Probably a bit too late in the day, as we'll talk about in a second, but that's definitely an issue. And then the third thing, within the whole Pershing Square group of things, they've got this structure, Pershing Square Tontine Holdings, which is supposed to be an ideal vehicle for people to reverse the IPO into. So you've got your unlisted company, you basically stock swap for shares in this. And that was designed to work by having support from the new vehicle, the existing London listed vehicle, and other funds managed by Pershing Square, as well as other interested investors. So now the sorts of deals that it can do are very much smaller, if it does anything at all. So it's really very bad news for his business, I suppose. Now, one of the reasons that people might have changed their minds at the last minute might have been the disaster that was UMG. It didn't look particularly good. It's not a huge fall. You can see there was the trading update on the 25th of July, basically around a slowdown in subscription revenue. So it's obviously selling music through people like Spotify and other streamers, and Amazon and Apple are supposed to have slowed down. And also they lost a bunch of revenue from Meta because they were streaming video content onto Meta, and Meta said we didn't want it anymore. So it still grew, but nowhere near as fast as it should have done. And even after that fall, it's still on a fairly chunky rating, about some 26 times or something. So it's a bit expensive. It's way too big a position in the fund. It's about a 25% position, but we don't know that for sure because they're quite cagey about telling us exactly how big the position sizes are. But nevertheless, it was way too big, and that was why I think we were keen to see it being sold down. And that not happening is obviously a problem. But maybe this will bounce and maybe it will be okay. We just have to wait and see. Now, JPMorgan Japanese. This is a fund that we write on, so you should hopefully know it relatively well. And it had a real tumble when interest rates started to rise in the West. There didn't seem to be an awful lot of logic behind that, as far as I can work out, because interest rates obviously were not going up in Japan. And so therefore valuations of growth stocks in Japan, I think, should not have been as badly hit as they were, but they were nevertheless they were. And this is very much a growth stock portfolio. It's also although it's in the large cap sector, not a pure large cap fund. It's got some small and mid caps in the portfolio too. It's a decent size, one of the biggest Japanese funds there is. And the discount's been coming in recently. And partly that's because the share price has been ticking up, but also the NAV's come off just in the last couple of days because the yen has started to move, and that's sort of people are readjusting their portfolios on the back of that. So there's been quite a lot of selling by US investors. So there we go. So that's been recovering. I mean, it's a slow and steady process, but it has been recovering. And actually, when you look at that shift from here to here, it is fairly dramatic. But the small cap version of the fund has not been recovering, and it was already too small. The discount's steadily too wide. It's buying back stock, trying to something about it, and shrinking. It does have a yield, but it's a manufactured yield because it's one of the sort of classic JPMorgan structures where they convert some capital into income to pay a 4% yield on NAV. But that wasn't enough to get people interested in the fund. And so it's been sort of slowly dwindling. The results that they put out on the 21st of June were not very good, and the board acknowledged that and said the result was disappointing. And at the same time, the main portfolio manager stepped down. So there was a bit of sort of succession crisis going on there. They needed to think about that. But the main problem, I think, because the board, there was no indication in those results that the board was thinking they needed to do something, but the shareholder base has got quite a lot of discount players on it. So City of London, Lazard, Allspring, 1607 make up a fair chunk of the portfolio. And they may have been agitating for something to happen in the background. You don't know. So the structure of the deal is exactly the same as we've seen with all the other ones we've seen. So Section 110 merger, JFJ absorbs SGI, which effectively is liquidated. There's a 25% cash exit, which is quite chunky. And that's a 2% discount to forming asset value. So it's the NAV after the costs have been taken out. The default option is shares in JFJ. So that's what you get if you don't tick any boxes or don't interact with it. The costs of doing the deal are all being covered by JPMorgan, but it's not a cash injection. They're basically going to say we're not going to charge a fee until JFJ's expenses have been covered. It doesn't cover the expenses of those exiting via the cash option. So that means that formula asset value will be knocked down a fair chunk, I would have thought, but we don't know how much until we see the paperwork. There's a quid pro quo too in terms of like a fee cut. So it's a tiered structure, much lower rates and much more sensible numbers than the last lot. And I reckon that saves about just shy of £7,000 a year based on the maximum amount of money going out the door. The ongoing managers stay the same. So you've probably seen Nicholas and Miyako present on here before. You obviously read our notes too. They are thinking about should they review the dividend policy. They're going to talk to shareholders first. Me instinctively doesn't like the idea because this is very much a growth portfolio, and so all of the income will be manufactured more or less. So it's sort of steady flow of money out the door. But we'll see. If people want it, then people want it. We're going to get the documents in September, meetings in October. Everything should be wrapped up by the end of October. I think this is a done deal. I can't really see anybody coming in and spoiling the party, but you never know. Now, let's hand over to Andrew.
Great, thank you, James. I'll just switch over to my screen and then I'll talk about this month's movers. And it was quite a decent month overall for investment companies. The sector was up about 2%. That's before today, so that was over the calendar month. And there were a decent smattering of double-digit gains, as you can see from the list. A couple of really interesting ones, actually, near the top that I'll talk about. And generally, there were some trends here. Some very obvious trends, in fact. So the two in purple, I think, were quite special cases that I'll talk about. But also amongst the risers here, there were a lot of smaller company trusts, in particular UK smaller company trusts, which have been rather out of the limelight for quite some time. And I'll talk about the rotation that's occurred in the market and has pushed up these trusts actually quite nicely in many cases. The flip side of that is that on the downside, we have seen some falls in the technology trusts that were previously leading the way. So Manchester and London, Allianz Technology and Polar Capital Technology all had a bit of a slide this month. I don't think that's, and it was interesting. I talked about these last month, didn't I? And actually, just what a difficult decision it was as to whether you should be putting any more money in at these extended valuations. So we have our short-term answer anyway here for the moment, but I don't think there's anything too fundamental to worry about. So if you're a long-term holder, I would stick with these. It's quite interesting that we've got the two Chinese trusts on the list of fallers here. My feeling is that that's really because of the preeminence of Donald Trump in the US and his probably favorite spot in the leadership now for the US presidency. There are quite a few worries that he will be restricting global trade, that he'll retreat to a more protectionist stance, and that will be bad news for trade with China and general relations. So I think that's why that's happened. But let's talk about Crystal Amber, which was one of the biggest risers over the month. The shares went up 20% yesterday. I have talked about this trust before, and it's a bit of a curiosity, really. It's a relatively small trust. It's in wind down mode, although that's a pretty extended wind down period. And it's a very concentrated portfolio. It's a really frustrating trust to be researching, actually, because it has a really terrible website and it doesn't produce monthly fact sheets, and it's really generally quite difficult to find out exactly what the positions are. But we do know that it has basically two very big holdings. One is Morphic Medical, which is an unlisted holding, nearly 50% of assets at the end of June. This is a very interesting medical devices company in its early stages, and its main product is actually a medical implant, which is really an alternative to these anti-obesity, anti-diabetes drugs, such as Ozempic, which you will have undoubtedly read about. This is actually an implant that mimics gastric bypass surgery, but it's quite easy to put in and to remove again. So it's a decent alternative. And this company is in its pre-sales period. So it's just trying to get all of the relevant regulatory clearances it needs to start marketing the drug, the implant, and to start selling it. I think on that basis, the value of the company is a bit uncertain. And that's why Crystal Amber actually commissioned an independent third-party valuation of the holding, which is obviously very important for this trust. And that's just come back and reported an end July valuation for Morphic of just under $100 million US. And Crystal Amber accounts for most of that. And this takes into account such things as the vesting of management options and so on. And what this valuation does, it potentially boosts the NAV here really very significantly. From the last stated value for Crystal Amber was 117.85 at the end of June. If you take into account this new valuation of Morphic, that leaps right up to 172.67. So that's clearly a very substantial increase. Now, I do have a little bit of skepticism about this because this was a report commissioned by Crystal Amber after all. So I think it's reasonable actually that the rise in the shares wouldn't have taken account of the whole of this increase. And actually, you see that in the market now that the shares are still on a 37.7% discount to that higher valuation. But it's nevertheless an interesting situation. And I feel after a quite long period where it was having a tough time of it, the wind is perhaps turning very much in the favor of Crystal Amber now, because this other big holding as well, De La Rue, the banknote printer, is currently in the throes of a possible takeover situation, and its shares are also standing close to an all-time high. So, I mean, it's a very interesting trust, I think, Crystal Amber. Undoubtedly very risky, though, because of that concentration. And that led me to have a look at other highly concentrated trusts, actually, which I think is really interesting because we have seen some big rises of late, not just from Crystal Amber, but also from the other one at the top there, Castleknow Group, which did very well from a debt reduction activity and its big holding in the Dignity funeral business. And we've also seen, of course, 3i doing tremendously well over recent years from its very, very concentrated holding in Action. But of course, for most of us, this is not really what investment trusts are meant to do. They're meant to be highly diversified trusts that, spread your risk. And so I think it's very much a two-sided coin, this, that you can do extremely well from some of these trusts when these big holdings are performing well, but there's a lot of risk involved. And so they're not for everybody. And I think the key thing is just to be aware of trusts that are highly concentrated, which is why I've produced this little list here. I just created this yesterday by having a think about some of the trusts I knew that were concentrated. So there may be some glaring omissions. Forgive me if that's true, but it is interesting to think about these trusts. And some of these, of course, are well known, like Manchester and London, which has been absolutely soaring over the last 12 months because of its big holdings in Nvidia and Microsoft. And we've seen some quite interesting changes here. So the one at the bottom of the list, Schroders Capital Global Innovation, that's the old Woodford Patient Capital Trust. I put that on there not because the holdings in Atom Bank and Oxford Nanopore are so huge now, but because they were, in fact, a lot bigger. So Oxford Nanopore was a much, much bigger holding, and that's been a case of where this concentration has cost the trust. So I think it's important to bear these kind of concentrations in mind, but they're certainly very interesting, and you can sometimes benefit. I think Hansa is an interesting case because Ocean Wilson's is pondering what it's going to be doing next, and there could be a potential uplift there, but it does certainly increase the risk. Of course, on the list here, I have not included alternative asset trusts where some of their projects concentration is also very high. We've seen that, of course, in cases like Digital 9 infrastructure. So those are also potentially risky. But let's talk about the market rotation that's occurred. And there's been a definite sell-off in the Magnificent Seven in the US. I think some slightly disappointing results from Alphabet and Tesla triggered this, but it seemed like it was a bit of an excuse, really, just to take some profits, take a little bit of money off the table after what has been a really fantastic run. I think as well that because economic conditions seem to be improving, or there's the potential for that to happen with some lower interest rates, this has meant that actually, if you're looking for growth, you don't have to be quite as concentrated any longer, and you can broaden out your search towards companies and trusts that are not so highly valued. And I think that means that UK smaller companies trusts have been particularly obvious as a place to look because we know that UK smaller companies are out of favour. There's been lots of M&A as evidence of that occurring. We know that the UK more broadly has been a bit of a pariah state as far as international investors are concerned now for a number of years. And of course, on top of that, you have the broader discounts in the investment trust sector as well, although they are starting to come in now. So you have this potential triple whammy of opportunity here for investors that are looking for more keenly valued stocks, let's say. And we have seen actually smaller companies in the UK starting to outperform large ones after a period where that wasn't the case. This chart here just plots the FTSE small cap index in the black against the FTSE 100 index in the blue. And you can see actually they traded in tandem for most of the last year, but in May, actually, we saw a bit of separation, and we've seen UK small caps starting to outperform, which again, I think has been a bit of a trigger for some money to flow back into the sector. So we'll have to see if that will continue. I dare say Peter will be addressing that question. I hope he will. And there are, of course, plenty of opportunities in the UK smaller companies trust sector. It's a very big sector. You need good eyesight to look at this, but I've ranked the UK small cap trusts here in discount order, so broadest discounts at the top. You can go and look at this yourself and get some up-to-date figures, but I think the point I would make here is that there is a very broad dispersion in this sector. And so, for example, towards the top there, I did highlight actually a couple of months ago in my newsletter the anomalous situation of Oryx International Growth, which in spite of its name is a UK small cap trust. And that's trading on a much, much wider discount than its Harwood stablemates, Odyssean and Rockwood, which are both on premium ratings. So I think you have to pick carefully. But to my mind too, whilst the valuation is important here, clearly in the UK small cap space, stock picking is of paramount importance, and the quality of the manager is really, I think, the absolutely key thing. So you have to be quite careful, I think, about how you're picking. The final slide from me is just really relating to yesterday's news. Yesterday's news that interest rates were cut modestly by the Bank of England. This was a slight surprise. It was a 5-4 vote on the Monetary Committee, so very close. And the market actually reacted well initially and then decided that because actually the Federal Reserve was not cutting its interest rates, it wasn't that impressed after all. My sense is, though, that this is very good news in the medium term for the investment trust sector. It's not only supportive for UK smaller companies, but there are a number of very important sectors actually that ought to benefit from this. These are generally the ones that we've seen being quite depressed over the last couple of years. So real estate is an obvious beneficiary of lower interest rates because debt is always a big part of the asset mix there. Infrastructure and renewable energy, because these trusts are competing perhaps to some extent with returns from UK fixed interest, that's relevant. And also because, of course, they value their assets using discount rates. And if the discount rates come down, the value of the assets goes up. So I think actually this could prove very important for those trusts which are generally on very wide discounts at the current time. The third sector there, the final one, is growth capital, where again, if you're an investor looking out at future returns from growth capital, which could be some years hence, and you're discounting those back to present values, if you're using a discount rate that is lower now that interest rates are coming down, that increases those present values. So again, that may encourage investors to take a fresh look at some of the growth capital trusts that are still on very wide discounts. So overall, in spite of the market's near-term reaction being somewhat less than excited, I think it is very, very good news for the investment trust sector that interest rates appear to be coming down at last. So in the absence of any questions, I think that's it from me, James. So I'll hand you back for a chat with Peter.
Great. Thank you very much, Andrew. That was interesting. Definitely useful. And yeah, probably some food for thought for what Peter's going to say, I think. So good morning, Peter. Thank you very much for doing this again. This time we get to talk about the fund properly. So without further ado, I'm going to let you just describe a bit about what CT Global Managed Portfolio Trust does, please.
Okay, James, well, good morning. Good morning, everybody. CT Managed Portfolio Trust, yes, it's a fund of investment trusts. It you should think of it as a long-term savings vehicle, almost exclusively for private individuals. We've got no other shareholders, private wealth managers, institutions. It's just individuals. And we've got two portfolios, one of which is a growth portfolio, and the other one is an income portfolio, but really think of it as a total return portfolio. And actually, they are quite separate, but within the one company, except for one thing. And I'm going to very briefly dwell on the bottom 3 points you see there. Transfer of income between the portfolios, which is a unique feature, which I'll come on to in a moment. We have a conversion facility. You can switch between the two portfolios at a pretty low cost level. It's the trust picks up most of the costs, and we keep a very tight control of the discounts. So we go over to the to the next page, this is the income transfer, and I apologize if it looks a little bit difficult, but actually it's not really as difficult as this may appear. If you can imagine the two pools, the income pool and the growth pool, worth 100 at the beginning of a year, and let's imagine there is no change in share prices over the year, which I know is ridiculous, but nonetheless, just for the basis of this example, the income pool, really since day one through to today, yields somewhere around about 4.5%. And the growth pool, focused mainly on capital growth investment trusts, yields round about 1.5%. And when the dividends, let's just say a Scottish mortgage dividend, that's a holding, so trust everyone knows, when that comes into the growth pool, it's then put on a conveyor belt and shifted across to the income pool. And over the course of a year, you have just over 1%, because that's the dividend yield, which is effectively transferred from growth to income. But at the same time, the same amount is transferred back from the income pool to the growth pool, except it's called capital. And so what is the result of this? Well, the result of this is that the growth pool does not pay a dividend, never has done, never will do. But at the end of this year, its NAV has been boosted actually by 1%. So it's got an NAV of 101. The income pool, on the other hand, sees its dividend yield of actually about 4.5, roughly, is its natural yield, is boosted over 5, somewhere between 5 and 6, courtesy of the extra income it's receiving. However, it also gives up about 1% or 1.5% of its NAV at the end of the year. So very briefly, that has been massively beneficial for the income pool. It has also been beneficial for the growth pool to some extent. It customizes returns, but it's meant with the income pool, I've never really been short of income. I've never had to go up the income spectrum to some quite high yielding trusts. So that's the income transfer. Hopefully it has no adverse tax implications either for the shareholders or within the trust itself, because all HMRC sees is the box on the right, because it's all in one company. And if you go on to the next page, once a year in October, actually, we have a conversion facility. You can switch between growth and income or income and growth. Under the current law, it's not treated as a disposal for capital gains purposes. We keep costs to an absolute minimum. The trust actually picks up most of them, and it's done at asset value. And because we keep both share prices pretty close to asset value, it's a good way if you want to transfer. And sometimes people, as they perhaps have been in the trust for 10 or 20 years, in the growth pool, they find a requirement for income. Well, here's a good way of doing this switch quite cheaply. And then the next page, couple of pages, just shows you what the history of the discount's been really since launch. That's the income portfolio. It trades at a very small premium and has done for, quite some considerable time. And we keep both income and growth. The growth actually is at a small discount at the moment, 2 or 3%, by a very active share buyback program and or share issuance program. So these are these three features: the income transfer, conversion facility, and how we don't want a double discount appearing here with our two shares. So we keep both share prices tight to NAV. Right, so let's move on, and that's just a summary, really, of the trust at the moment. It started in 2008 with 40 odd million of assets, and now it's actually pushing 170 million of assets, and it's got over 16,000 shareholders. So actually, that's a huge amount, and it shows there's lots of very small shareholders indeed. average shareholding size is between 10 and 12,000 pounds. So this is really a trust for individuals. Let's keep moving on and keep the pace up. I just want to put in context what's been happening with investment trusts. I'm sure most of the listeners are aware, but this is a simple chart of the investment company subsector within the all-share index relative to the all-share index. And the way to read this is, if the line is rising, then investment companies are outperforming. And you can see there this is a chart of 10 years, but you could go back longer. Investment companies do tend to gently outperform. And then we had this period in round about lockdown, actually, where investment companies really performed incredibly well. And we got to late 2021, and what happened then was interest rates started going up to combat inflation, which itself was beginning to rise and rise sharply. And that had a very negative effect on the investment company sector. And you can see it gave up almost all of that outperformance that it had in 2020, 21, in the space of just a couple of years. More recently, in the last few months, there are some encouraging signs that investment company subsector is beginning to outperform. If we go on to the next page, sorry, that's just a page my compliance insisted I put in as what is an investment company discount. Let's move on beyond that. And this is a good chart and just explains really one of the key driving factors to the underperformance in 2022 and 2023. And if you can see there, the chart on the left, that's a chart of the average sector discount, which for long enough was round about 5, 4, and it even got to 2% in 2020. And very briefly, in the summer of 2021, it was at par. But then, as I said, interest rates started going up just before Christmas in 2021. And look what it did to discounts. Discounts widened out really quite sharply. And the average sector discount by last November got to 19. And so that tells you the share prices underperformed the asset values massively. And therefore, we didn't do well. Investment companies did not do well. Chart on the right shows you really the past year or so. And you can see how we got to 19% there in November. But things have begun to tighten in a bit more recently. And actually, as we speak today, the average sector discount is just over 12%. So that's helpful. And it shows that things are beginning to stir in the investment company sector. So that puts in context what I invest in. If you go on to the next page, I just thought I'd take one page on the income portfolio just to put in perspective what the dividend yield is. And the dividend yield on the all-share index as of today is 3.6%. On the all stocks index for government bonds is 4.25%. And for the managed portfolio trust income portfolio is 6.15%. So that's quite a high yield. But if you look at the dividend growth, and in the last year we grew dividend by about 3%, we've actually achieved dividend growth over the last, I think it's 11 years. We're now an AIC next generation dividend hero. So you do get quite a big dividend here. And I'm not going to predict or forecast dividends, but all I'll say is the revenue account is in a very healthy place. So hopefully we're going to seek to continue that. Now, the next page does show you the performance, and you can see there the 5-year numbers in particular, even to some extent the 10-year numbers, were affected by really the very difficult period of 2022, 2023, when investment companies underperformed the all-share index very significantly. But have a look at the 1-year numbers. They've actually turned quite sharply for the growth portfolio. It's now outperforming the all-share index. It had a very strong July, and so that's been extended. The income portfolio was still lagging, courtesy, as I think Andrew hinted at in his talk, the alternatives sector which really had underperformed substantially and discounts had widened a lot. The income portfolio had had one of its best ever months in July, so that's in the process of turning as well. The longer term numbers, which have been affected by what went on so significantly in 2022 and 23, are still just about okay since launch. And if you go on to the next page, I'm not going to dwell on this too long. I have to put this in for compliance reasons. That's each individual year. And all I'll say is the growth portfolio outperformed for 9 consecutive years up till 2022. And then the wheels came off the wagon, as it did for investment company sector generally. The income portfolio actually has been much more steady, but it too has had a difficult time in the last couple of years. But actually, if you looked at the since inception numbers right now, they're both ahead of the all-share index. So moving on now to the themes and it's quite a busy slide, and I do want to spend just a moment explaining to the audience. My key investment theme, and again, Andrew touched on it a little bit when he was talking, is UK equity trusts. And I think they are looking really attractive just now. The stock market's been out of favour for years. Valuations are low. The profits outlook is okay and beginning to improve for later this year. And a lot of trusts in this area have been actually at quite wide discounts, albeit in the last few weeks, that's been beginning to tighten. So I've got some examples there. I've got big holdings in Fidelity Special Values, Law Debenture, Aurora and Aberforth. They're all in the top 10 of the growth portfolio, and they've all been performing quite strongly. Henderson Smaller Companies up 15% in July. And then in the income portfolio, it also has quite a lot of exposure to UK equity trusts. Mercantile is the third biggest holding, Temple Bar. And then the JPMorgan UK Smaller Companies Fund has really also performed strongly, and it too is up 15% in July. So that's capitalizing on what I've been trying to outline there is a very cheap market. I think the narrative for the UK market has flipped. And I don't think politics often has much of an impact on markets, but suddenly we've gone from a period of really a lot of instability economically and politically to, whether you like it or not, there's now political stability, a focus from the government on growth, and actually the growth numbers are beginning to come through. We've just had an interest rate cut, which is massively positive for particularly trusts in the mid and small cap arena. So I think UK equity trusts could have a period of quite significant performance, having had a period of horrible performance really since the Brexit referendum back in 2016. I've got a decent exposure to private equity trusts. I think the discount's still wide. I visited Pantheon the other day. That discount is somewhere around in the mid-30s. And yet asset values, and Pantheon's a case in point, they produced their annual results. The NAV was up 6% and will probably be stronger than that in the current financial year. My biggest holding is HG Capital, which specializes in software companies. And this is a very unloved sector. And I think if we do get some result in the cost disclosure issue, which you might want to touch on later, this is a sector that will benefit hugely. The long-term records of some of these trusts is absolutely outstanding, and actually I think should form a part of everybody's portfolio. How else do you get exposed to high-growth private companies? So I think that's an interesting area, and I've got some holdings in the income portfolio too in private equity. And then finally, trusts with secular growth characteristics, mainly focusing on technology, healthcare, and the likes. And actually, they sold off sharply in July. And Allianz Technology, Polar Cap, and Scottish Mortgage all were down by quite a number of points, as there was a sell-off in the US tech sector. But be under no illusion. It's from trusts in this area that you will make many times your original investment. And so my only message here is stick with them. I'm going to, because I think I want to have exposure to growth, particularly for the growth portfolio. And so whether it's Scottish Mortgage, Worldwide Healthcare, Polar Cap Technology, they've all done really well in the long run. And I think they should form a core of the portfolio. Right, so if we can just move on quickly here. Here's the top 10 of the growth portfolio, and I tried to reflect some of what I've been saying there. So you can see there, I think, are 4 UK funds, and they've all got there through performance. It's not that I've been buying more of them. You can see the technology funds there, Polar Cap and Allianz Technology, and also private equity. And I've got one, Oakley Capital is the 11th biggest holding. So that is, I'm quite comfortable with that top 10 just now. And if you go on to the next page, you will see what I've been buying or adding to in, really this is in the calendar year. So I've added some more to Aberforth. I bought a position in the JPMorgan UK small cap growth and income portfolio following the merger of the small cap trust and the mid cap trust that JPMorgan undertook. I added some Allianz and Polar Cap Technology at the turn of the year and bought quite a big position in Pantheon International as well, and also added some Scottish Mortgage, which is really, it's a big trust, Scottish Mortgage, but I think now it's definitely on the front foot and got some very interesting private equity holdings, which were viewed negatively for 2 or 3 years. But I think some of these ones, SpaceX in particular, is looking quite interesting. And then they were funded by some sales that I undertook, and you can see there, sold out of Hypnosis following the bid. And I've sold down some of the more defensive holdings like Capital Gearing, Personal Assets, sold out of Ruffer completely, because I'm now much more positive for the outlook, not just for the economy, but more especially for the stock market, and try to reflect that in some of the themes I've outlined for you. And then for the income portfolio, here's the top 10. You actually might notice Law Debenture appears in both portfolios, as does the JPMorgan UK Small Cap Trust, because they've got very good yields, both of them. But broadly speaking, I've tried to reflect the same themes. So UK equity there with Law Debenture, Mercantile's performed very strongly, as has Merchants Trust. City of London is there too, great dividend stock. And we've also got private equity holding with NB Private Equity. It's harder to get some of the technology trusts in there because they just don't yield. I've got one International Biotechnology, which is in the top 20, but I'm afraid it's difficult to get its secular growth holdings in there. And in the next page or two, you'll see what I've been buying and selling. And so there you are. TR Property is one I actually really am quite optimistic on. And I think what we had yesterday from the Bank of England is very helpful for the property sector. That is a well-managed trust. It's got a fantastic dividend record. It yields somewhere around about 4.5% and is a great way to play listed property companies. The manager, Marcus Fairmudge, he really knows the sector, is very experienced there. So that's what I've been doing on the purchase side, and on the sales side, you can see we came out of Hypnosis. And actually, I like all these other 3 holdings, but I've just gently top sliced them because they've done quite well over the period. And so I think the next slide is probably the final slide, James, and it's really just what are the prospects for the next 18 months or so. And my point here is just to say that valuations in most equity markets are quite high and above long-term averages. And you can see the UK, the US forward, that's the next 12 months price earnings ratio at 21 times, possibly 20 times now, given the recent sell-off, is well above its long-term average of about 16. There is only one market, major market, that is well below its long-term average, and that's the UK equity market. So let's try and make the most of that. And as you can see there, just to reiterate my themes, I've increased exposure to UK equity investment companies, and that's coming through now with quite strong performance. And it must be between 40 and 50% in both portfolios. But I've held on to my holdings in secular growth trusts, and also have raised earlier in the year exposure to private equity trusts. We were on very wide discounts indeed. James, that's a quick skate through the managed portfolio trust, but if you have any questions, then I'll do my best to answer.
We definitely do have some questions. Thank you very much for that. That's really helpful. So let's go back to just a couple of questions on the structure first. So given what's going on with the income here, how important is it that you actually cover the dividend with the revenue generated? Is that something that you're trying to do?
Well, the answer is yes. And we have a revenue reserve of roughly 3/4 of 1 year's dividend. So that should provide a lot of comfort as to the dividend outlook. But it's helpful getting that extra 1 and odd % from the growth pool, and it's helped us cover our dividends. And so that's one of the reasons why you're actually getting such a high dividend yield of 6% or so. So I think I'm comfortable on the revenue outlook. We're covering dividends. I think with a bit of luck, we'll probably cover them again in the current year, but it's early. We're a May year end, so I don't want to give out any forecasts. But the revenue the revenue account is quite healthy, and the underlying dividend increases from investment companies tend to be in the 3, 4, 5% region, which is reasonable. So I'm quite happy in that area, James.
Okay, good. Thank you. I suppose that there's a sort of big picture question here. Is it how do you actually decide what makes a good investment?
Well, now that's a $64,000 question, and the answer is it's not easy. I do spend quite a bit of time actually meeting the managers of trusts that I've got holdings in or might potentially have holdings in. And actually, it's only with sitting down with them maybe for an hour or so that often you can get to the real bones of what their investment process is, their investment strategy, what style they employ, and also you look for experienced managers who've perhaps been around the block a couple of times in terms of different market conditions. You can also, yes, do a bit of work with analysts or indeed the annual report, which I do actually read most of them. And actually what you can find out there is, well, what's the level of gearing? How is debt structured? Because often gearing can make quite a difference to returns, particularly in the alternative sector. We've got examples there. Hypnosis, which I did own, and I quite liked elements of what they were doing, but too much debt really undid a lot of the good work that had initially happened with hypnosis. And so you've got to be on top of what's going on with balance sheets and levels of gearing and levels of debt and how that's structured. But you can also look at costs, fees, performance fees, how are costs allocated, all these sorts of things. You can build up a picture of trusts. And I try and dovetail it with a macro view. In this case, you can see I've been quite optimistic about the UK. And so, you know, how can we try and capitalize on that? And you've got a series of really good managers with trusts there. But if you looked at the record, you would see most of them have been underperforming for the last year, 3 years. And you would say, well, why should I bother? But actually, that's when you can really dig underneath and try and find out what's been happening with leadership in the market and investments within the market. And actually, you decide, well, if I'm going to be a bit more optimistic about the UK, I think the following trusts will do quite well in a different environment. And that's what you see there. So
Trying to get that message across. Just don't buy what's been going up. Go and actually look for things that are cheap. That's the hardest thing. I think that's just most of my job. There we are. Now, obviously, because you're buying trusts, and you mentioned cost disclosure before, can we just sort of talk through what your ongoing charges ratio is, whether you think that affects whether people invest in the fund or not, and what you think the right approach to cost disclosure ought to be, please?
Well, our ongoing charges are just over 1% for both portfolios, and they've come down very slightly over the last few years as they've got a little bit bigger. But then if you look at the underlying costs in the KID document, they appear a lot higher. And if I said something like 2.5% of that order, and that's actually boosted a lot by me investing in private equity trusts, which superficially are very high cost vehicles. Now, there's some reasons for that. They have to employ more people. It's a different type of investment than investing just in listed FTSE 100 companies. I mean, I think private equity trust fees are generally too high. But I do my best to try and kind of see the wood from the trees, because despite, in inverted commas, these very high levels of costs, why is it that these trusts are amongst the best performers over the long term, miles ahead of the all-share index? I mean, Pantheon is a case in point. I think it listed in 1987, and its NAV is compounded at somewhere between 12 and 13% per annum, whereas the all-share index, I think it's somewhere between 6 and 7. That's with these apparently outrageous costs.
Yeah.
So, you know, I think we just have to just keep an eye on what the final output is and the final share price return. Now, I hope there is movement on cost disclosure, James, because I think it's embraced within share prices. And if there is a discount, then that often could be due to higher levels of cost, amongst other things. But it makes investment companies appear to be a lot more expensive than they actually genuinely are. And therefore, I think it puts off, certainly in the private wealth audience, and I understand that. But I think hopefully if we get some resolution regarding cost disclosures, that could be good news for particularly the alternative sector within investment companies.
Yeah, I agree. Thank you. Now then, HG, you mentioned, obviously your biggest holding here. What is it you think about that trust that's made it so successful?
Well, HG Capital is it's a private equity trust. It focuses on predominantly software companies in the business-to-business sector across Europe, and that's lots of different areas too: payroll, accounting, HR, whole variety of different sectors. A very fragmented area. But typically, companies in the HG hold have quite predictable revenues. The clients they deal with will tend to be on a 1-year rolling basis, for example. So HG and the companies they own know well in advance what their revenues are going to be. They're growing because they're particularly addressing small and mid-cap companies who are who require, you know, sort of more, how can I put this, in the field of digital transformation, payroll, accounting, more prosaic areas. That's a huge cost saving for underlying companies. And so they contract with some of the HG's holdings, and presto, you've got some very interesting businesses across Europe. And actually HG Capital, I think they were saying that if it was the underlying companies were listed, they'd be the second biggest software company in Europe, which is amazing.
Yeah,
so it's had a really rapid NAV growth, and I think the long-term future is still very good there. Now, it's got it's the best rated of the private equity trusts, and it's not far off asset values as we speak. But it's one you want to have for the longer term. So that's why I like it. And I bought it in I think 2015, and it's made about 4 times the money since then, which is not bad going.
No, exactly. So in the income portfolio, you've got 3i infrastructure in there. Have you got much else within the kind of renewables and infrastructure sectors?
I've got a bit, James, and they were amongst the worst performers in the last year, albeit the dividends came through fine. But Greencoat UK Wind is just outside the top 10. I've got the Renewables Infrastructure Group, which is further down the portfolio, and they both have been selling at quite wide discounts. I've got 3i Infrastructure, which has done quite well, and I've got 1 or 2 other alternatives, like, for example, Impact Healthcare, which again has been yielding close to 8%, and the yield dividends been growing, but the share price has underperformed substantially. It's now at a discount of well over 20% to NAV. So in the past year, 18 months, it's not been helpful for performance, for the capital performance of the income portfolio. But in all cases, the dividends have come through really well. And in the long run, you see 3i Infrastructure there. I mean, that is one of the best performing stocks in that portfolio, has been 3i Infrastructure, which I've had for 10, 12 years. And it's been a fantastic, the capital growth from that has been outstanding, along with a dividend that's compounds at 6, 7% per annum. I think it's ideal for an income portfolio. Now, going forward, it's not clear with renewables yet. I haven't formed my view. I like the income that we're getting, but they are very out of favor. And I think the one thing that has perhaps disappointed, not just me, but investors generally, has been the asset value performance is not really linked to what's going on with the FTSE 100 or the S&P. It's to do with other issues like power prices and revenue and things like that. But the share prices have been very sensitive to bond yields and interest rates. And I don't think any of us really appreciated quite how sensitive until recently. So now, with interest rates coming down and possibly bond yields also coming off a bit, actually, I've just been finishing writing my fact sheet for July. One of the better performers in the income portfolio was Greencoat UK Wind. Shares were up 10%. So be interesting from here what happens.
Yeah, definitely. And you mentioned Impact Healthcare REIT there. So what do you think about property sector? You mentioned health property too. Do you think that's
Yes.
something you'd like to have more of now, or
Well, yes, I actually Impact is about the only. I used to have quite a number of specialty property companies. I remember Supermarket Income REIT, Assura, and others, LXI REIT, which actually got acquired. Although I own Secure Income, which LXI first acquired. But I kind of, in the short and medium term anyway, I've decided, yes, I quite like the property sector, but I want to play that through TR Property. And if anything, I would own more, not less of that one. I think it's well managed and it should be performing, and is. It was one of the best performers in July, James. But whether that continues or not, I'm not sure. But I do think that's the way I want to play property at the moment.
Great. I think we covered an awful lot of ground, and hopefully people learned a lot about the fund. So we'll get you back again another time. But thank you very much for your time today, and good luck with it all. I do like the whole approach, as you know. So there we go. There's the disclaimer. We must put that up. And then we'll be back next week talking to Matt Cable from Rights and Issues. Now that Dan's gone, he's the sole manager there, so it'll be interesting to see what you've got to say. And sticking with the UK, we'll have Ian Lance from Temple Bar the week after. And then we've got a full lineup all the way through. And our new panel show, Peter was on the last one, but the new panel show for September is going to be talking about the new government and what impacts that's having in the UK. So thank you very much for tuning in today, and we will see you next Friday. Have a good weekend. Thanks. Bye-bye.